Hello guys, my name is Gavin. Welcome to M Trading's webinar. So this is our weekly webinar. We cover most specific topics. Today we'll be talking mostly about the 5 main downfalls of a trader. But then I'll also implement that within the charts. But before we do that, let's go into our website. This website is extremely important, guys. This is where you should be going for your technical, fundamental analysis. We use this on a daily basis. So going into fundamental analysis, to develop that further, go into this specific website. You can understand geopolitical concerns in addition to other fundamental analysis that you require. The most recent RBNZ on the interest rate decision from last night. That's one of the key points there. Okay, yep, so that's all your fundamentals. In addition to that, let's just move back to technicals. So going to technical, this is updated on a regular basis. So you have some of the best traders with M Trading who will give their own technical analysis and charts to you, so you're able to better understand what specific levels to trade at. We incorporate trend line support, resistance, Fibonacci's and moving averages, and secondary indicators such as the RSI. All that's been covered in previous webinars. So yep, please do go through this specific part of the M Trading website, which is the technical analysis. Okay, so chart-wise, guys. Okay, so let's talk about the downfalls, the 5 major key downfalls to remember based on trading. Yep. The first I'll say is position sizing and over leverage. Yep. So what I tend to see is, what I would say before I start off the 5 major downfalls, a lot of the downfalls I would say are not specifically your technical analysis, because technical analysis you can be wrong. You can make a mistake. You can do all the analysis, put enter a trade, and if it goes against you, that's fine. That should be fine. You should be able to take a loss. You can never have a 100% hit rate. But what you can't do is take a 10% risk on a single trade. That doesn't make sense, because then you're more than likely to blow up your account in a very short period of time based on very few trades. So leveraging too much or risking your position size at a larger amount is the number 1 most significant downfall there is. Yep. Okay, so the idea is a single trade does not make me a good trader, guys. A single trade does not make me a good trader. What makes me a good trader is how long and how consistent do I make a profit. Yep, so I've been in the market for coming on close to 5-6 years now. 5-6 years trading live money. Yep, so trading live money, building up a portfolio, building up a fund, trading other my investors' capital. Yep. So therefore, I've built up consistency, and I have over 3, 4, 5,000 trades under my belt. So one single trade has never defined me, and it shouldn't for you either. Yep. So remember, you want to take always have a position size that makes sense. Yep. So I'm very conservative. My risk per trade is at 0.25%. That's a very conservative risk. What I would say risk aggressive is 1%. Yep. So on the flip side, if you're quite aggressive, go between 1, maximum you can go is 2%, but nothing further. Yep. There are these old school ways, I'd call it, which are, for example, turtle traders. So a lot of you guys would have heard about turtle traders. You might have watched a film called Trading Places with Eddie Murphy, which is based on turtle traders, and this is a real event that took place where 2 top traders in New York got together, and they had a bet, and the bet was that could they train someone, the average man, train the average man to be a very good trader. So they took this bet on. They took on people from different backgrounds and different sort of education levels and so on, and they taught them their system. And all they had to do is replicate that system. Of that, there have been, of that group, of that elite group that was taken on board, I'd say there's only been 3 or 4 of them that have made it successfully as a good trader, and there's only been 1 or 2, I think, 2 in my mind that I can remember name-wise, that have gone on to be very successful. And one I can mention to you, which is Jerry Parker. So research Jerry Parker from Trading Turtles, and you will know how well he has done. Yep. And the way they positioned their risk originally was that they used to take 25% risk per trade. Now you must be thinking, wow, how can they take 25% per trade? The idea is that they didn't take their initial trade at 25%. What they would do is they would test the market with a 5% position. Once that continues to break levels and go in their direction, then they would incrementally add into that position up to 25%. So they were never in one trade fully at 25%. They were adding into the position as it's going in their direction. Yep. So do remember that, guys. And that type of trading does not exist in institutions. Institutions' industry standard is 1% per trade. Yep. Okay, that leads me on to the next biggest downfall of a trader, which is number 2. It is averaging down. Another great trader you can research into is his name is Paul Tudor Jones. He has unfortunately made the largest significant loss from all the hedge funds of 2016. So 2016 and 2017 was a very bad years for Paul Tudor Jones. His hedge fund actually lost, I think it's in the region of 25 to about 30%. But he comes from that period where they used to take larger positions and so on. But he has always said averages loss averages. Yep, so averages loss averages. So averaging down, so what does that mean? So what that means is, for example, let me just bring up a chart. So if I go into specific, okay, so I'm just going to zoom out of this chart over here, and it's this. Okay, let's assume that I have taken a short position. Not sure if you can see that. Let's try that again. Narrow it down. There. So I have a trend line over here. I have a trend line, and I've taken a short position once we break this trend line. And what takes place? Okay, so I'll just move this way. So what takes place is the market starts to go against me. As it starts to go against me, I then go on to add to my position, and I get in at this point. So I get in at this point over here, this level. As that continues, it starts to further go against me, and then I go on to add again. So I now am building my position into losses. So I'm losing here, I'm adding to my position, so when it moves in my favor, so by the time, so the benefit of this, so the way traders view this system is in this way. So assuming that I got in at this point, yeah. So if I got in at, let me just use a indication that I can use. Give me a second, guys. So getting in at, so getting in at this point over here. So the loss that I'm taking when price is moving against me, if I add in at this point and then the market goes on to move in my favor, by the time it gets to my original break even, I would have made profit from this trade over here. Yep, so by that point I should be back to break even. That is the thought process there. Yep, but the problem is, most of the time when you are wrong, you are wrong. Yep, so when it goes against you, its market is showing you that you've made a wrong decision. But adding in and being biased in your view, in your mentality, leads to, okay, get in at this point, it goes further against me. get in at this point, and it still goes against me. And then at this point over here, you are taking such a significant loss, you may end up deciding, okay, I've hit my stop loss, or I've hit my maximum limit, the broker's closed me out, or my position, I'll close my position out. Yep, that's when you take significant losses, guys. Do not look to average into your losses. Yep, so don't look to average into your losses. What I do condone is do the opposite. Average into your winners. It only makes sense if the market's going in your favor, add into it. That is what the Turtle traders do. That's what a lot of successful traders do, is to average into winners and not average into losses. Yep. Okay. So let's give you an example, guys. To give you an example, let's remove all of that. Okay, let's assume now, guys, assume that I have market going in this direction over here, but almost a wedge formation taking place there. The prior trend has been down. We have the breakout. We enter at this point here. We have our stop loss over here, and we're trading. So we're in at this point here. It starts to make a retracement. We have another trend line at this point here. Breaks again. Another entry. So that's my second entry there. That's my second entry at this point. And let it continue. As it continues, as you enter into more positions, and that's our third entry, that's fair enough. Only when it starts to go against you, that is when you look to take profits. I'll take profit when it starts to pull back from this low, it pulls back by this amount. That's a far enough point there. So I'm looking to add in to my winners. And that's the key point there, guys. So that is my second point there. Yep. Going on to my third point, and my third point is always maintain a stop loss and a take profit in all your trades. Yep. I see this mistake taking place on a daily basis. So one thing I would say is whatever your view is, you should always have a stop loss and a take profit. I don't mind you having a wrong trade idea, so it's more than likely you will have losses. Yeah, more than likely you're going to have losses. Yeah, but it's about how much you lose and when you cap that loss. The idea is to always have a stop loss and always have a take profit. Reason being, the idea is if I always have assuming that we enter at this point over here, so entry was through the break of this level to go short, and I have a stop loss above the high. By having a stop loss, I've defined that, okay, I'm taking a risk of this amount. Taking a risk of this amount, so if it goes against me, I know that I've made an error of judgment. I know that the market's going to go against me. Yep, so that is where I'm limiting my risk, and set your 1% risk or 0.5% risk to that pip distance. Yep, and take profit. If I've defined that is the previous low, so that is the previous low, this range here, I will take profit when we reach this point here. That will be my take profit level. The idea is to set realistic targets. Always set realistic targets. It doesn't make sense to have unrealistic targets. You can't expect one trade to make you $1 million. You can't expect one trade to take you to the moon and make you all the money that you're expecting. It doesn't work like that. 99% of traders that have consistently and been very profitable in trading have made it over many trades, not a single trade. So expecting that to take place in one trade, the likelihood of that is almost you're more than likely to win the lottery. Yeah. So yeah, build into your positions, be a consistent, look at your position size, look at consistency, and look at the longer term objective. Yep, and that is my third point, guys, which is always have a stop loss and always have a take profit level. Yep. Okay, moving on to my fourth point. So my fourth point is holding on to losses. Yep. So holding on to your losses and taking profits too quickly. There is a well-known quote which is in the markets is let your winners run and cut your profits let your winners run and cut your losses quickly. Yep. So the idea is always look to let your profits go in the direction that they're going. So it's very easy for you to see that the market's going against you. So let's do an example of that, guys. Okay, so let me just highlight a specific point here. Okay, so assuming that the market is going short currently, so market's going short currently, so I'm entering at this point over here. Yep, so this entering over this point over here. Yep, and then the market starts to go in my favor. As the market goes into my favor, yep, we're at this point over here. So assuming that we're at this point here, every time it starts to make a new low, it starts to go in my direction, I'm thinking, oh, I've made a lot of money. So from originally risking $100, risking that $100, yep, so I was risking $100, I'm now up $100. I could take that profit. So once you're at this point here, you'll be like, okay, I'll quickly take the profit here. So once you take that $100, what does it go on to do? It goes all the way down where you could have potentially made $1,000. That's what tends to happen. Yeah, so you had a chance to make $1,000, but you go on to take profit too quickly because you fear that you're not going to make that money again. So you fear that the market's going to go against you, and therefore you'll close that position very quickly. That is the fundamental flaw in a trader. And I'm sorry to say, guys, it's in all of us. It's something that we need to now hone and train ourselves to become a better trader, where we let profits run but cut losses quickly. So to tell you about the losses, now let's flip it to the losses. Yep. And the losses are, to be specific, so the losses, to give you an idea of that, assuming that the market, as we spoke about earlier here, is like this, we look to buy, it breaks out to the top side over here, that's a false breakout, we buy at this point here, buy at this point over here, and the market starts to go against us. And some people that don't have stop losses, what they'll do is, if the market's going against them, what are they doing at this point here? So the market's here, what are they doing? Okay, I can let this run a little bit longer and it will probably come back in my favor. So the key word I would say is hope. Yep, again, at this point here, okay, it's gone down further, and nope, I think this is the turning point. I'm going to hope that this turns around and starts to go back in my favor. Yep. So your fear and your anticipation in regards to what you could potentially lose is greater than what you are looking to potentially gain. And this is a well-known fact, guys, that your losses will have 2.5 times more of an impact than your gains. So it doesn't matter, if the gains and the losses are equal, your loss will have 2.5 times of an impact than your actual gain. And that's a well-known stat. Guys, if you want to research anything, research prospect theory, guys. It's called prospect theory. Yep. Okay. So as this market goes against you and against you, you are going to keep holding, and you're just hoping until it gets to such a low level, such a significant level, that you end up closing a position at that level. That's what will tend to take place. So the idea is always have a stop loss. If you had a stop loss at this point over here, below that previous low, you can say, okay, it's gone against me, hit my stop loss, that's fine. The overall trend was down. Yep, so you can have a wrong trading idea, and you got out at the correct time. What I don't want you to see, I want to see is it starts to keep going against you, and you're holding and extending your stop loss further and further and hoping for it to turn around, because that is the wrong thing to do. You're holding on to those losses. Yep. So that is my 4th point, which is holding on to losses and taking profits quickly. The final point, the 5th point, the final point, which is I see a lot, which is you're trying to catch a falling knife. So there is a thing called value investing. Yep. So a lot of traders they've heard about Warren Buffett, Charlie Munger, Ray Dalio, and all the other sort of value investors that we know about. And what they want to do is implement that into your trading account. And what they tend to look to do is, when a market has significantly sold off, what they'll do, they'll assume that it is undervalued. It's undervalued, and they will look to buy at that point. But what you have to remember, guys, is that you're a momentum trader. Yeah, on a day-to-day, on daily basis, weekly basis, you are looking to trade with the momentum, not catch undervalued or overvalued stock. And it's slightly more difficult. You can do that when the market's ranging in a sideways in consolidation, or when you've got that very long-term approach and where you're at a significant support, significant resistance level. Yeah. But doing that on a basis of just looking at a strong sell-off, that is not the correct thing to do. So a lot of traders, what they'll do is they'll try to catch a falling knife. They'll end up seeing a market like this. It's such a strong sell-off. So you see a large, significant candle such as this, another large candle such as that. Yeah, so large few candles there, and they'll be like, okay, this is it. I'll start to buy at this point. I know it's going to rebound significantly. So they'll buy at this point. It does pull back, but the overall trend has been down. The overall trend has been down, and it's forming a downtrend, and it only continues lower. Even this perfect example, you're assuming that's a significant sell-off. Now it's undervalued. This is the area where I could look to buy. You end up buying, and what does it do? It continues lower. So don't look to catch a falling knife, guys. It's extremely important to have a better understanding of the markets. Understanding value investing is based on fundamental analysis, and it's extremely long term. Whereas trading is more about trading with the momentum, trading in the direction of who has the control. Are the buyers in control, or is it the sellers in control? So that's the idea, guys. Okay, that covers all 5 points, guys. Those are more related to, well, they are both related to risk management and trading strategies. Yeah, so trading mentality, in fact. None of those are actually how you take a trade, or your actual initial trade setup, or your management, or whatever it might be. Most of it comes down to taking a trade entry on the wrong mentality or with bad risk management. And that is so important, guys. I want you guys to remember that trading psychology and risk management are two important factors that are not valued by traders. Traders will either focus on fundamentals or focus on technicals. They completely disregard risk management and trading psychology and mentality. So please do work into that. Okay, thank you for listening, guys. Take care. Bye-bye.